Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring. And today I have a special guest. Very excited to have Michael Lamothe here. He is a best-selling author. He's a trading coach. He's the creator of the Trade Gauntlet, founder of, is it MARA Wealth or MARA Wealth?
I say Mara, you say Mara, tomato, tomato. It's all
Tomato,
good.
tomato. And Mike, thank you so much for being here. Mike has a brand new book. I've been reading this book over the last week. It's called The Trading Mind Wheel by Michael Lamothe. I see he has a nice introduction here by Mark Minervini. Very nice. And you can order this book, pre-order it right now on Amazon, Barnes & Noble, BAM, Target, Book Depository, and IndieBound. Is that correct?
Yes, basically wherever you like to buy books, it's there.
Okay, good. And like I said, I've been reading this book, and it's very helpful to me the way he describes trading as a wheel with spokes, and he has 8 different spokes that we're going to go over today as far as what makes the complete wheel of trading. And let's get started.
Sure. Thanks so much for having me on. It's a real pleasure, and hopefully we could deliver a lot of value to everybody listening today.
I hope so. I really respect you as a trader and an author and a teacher, and it's an honor to have you on.
Feelings mutual.
So, the 8 essential skills required for successful trading. Let's touch on those.
Okay, great. So the first skill that we go into in the book is mindset. And the reason why we start with mindset is because mindset has a hand in everything. There's one of my favorite market wizards, Van Tharp. He has a quote that says that you don't actually trade the market, you trade your beliefs about the market. Therefore, everything is 100% trading psychology. Everything is 100% beliefs. I fully agree with that. And that's why when I think about trading and the mind wheel concept, everything goes back to beliefs, because we can have beliefs about trading and money and about ourselves and things like that. But we also have beliefs about each one of the skill sets that are involved in trading and each one of the spokes. For example, journaling. I was speaking to somebody earlier today, and journaling is not a very sexy topic. Data entry or writing in a journal each day doesn't sound that great. And, just, why do I need to do this? My broker keeps track of trades for me, right? So in there's beliefs and mindsets about journaling. So how can we have a wheel that is perfectly round, perfectly capable of rolling down the path of trading success if, half of it's flat and, this other side is dented? Well, we kind of need this whole wheel to be fully inflated to be rolling down the path of success. Now, depending on styles, right? Like, there's a little nuance in this, because one of the first questions that I get when people hear about this mind wheel concept, well, do I need to be proficient in every aspect of what you happen to consider skills? I think that we just need to cover our bases, and what might be a critical area for one type of trader might be something that they at least need to check a box off in another. For example, let's say somebody doesn't really want to trade for themselves, but they want to at least be involved in the market, let's say. That person would need to have a certain skill, a certain knowledge base to be able to hire the right people.
Right.
So that's where I believe that the trading mind wheel concept comes into play, because it's really hitting all your bases, and then from there, once you've gained a certain level of proficiency where you're getting results, that's what can work.
Right. So mindset, beliefs, belief system, emotions, and habits. For those of us who have traded for a while, they are very important. Your self-confidence, how you believe in yourself, what kind of what you can expect. I've seen, including myself, sometimes during the years, I mean, you get a little down on yourself. You're starting to maybe get a little insecure. You're questioning yourself, and that's not a good spot to be in.
Yeah, no, not at all. Especially if let's say you're relying on trading to pay for the bills, to pay for the roof over your head, right? Now all of a sudden this losing streak becomes a reality. Like, oh, what are we going to do here? So yes, there's a lot that goes into trading, and confidence and self-belief, and all that kind of stuff.
Yeah. What do you suggest if you do get off track? What are some things that you suggest to help you get back on track if you're feeling down, if you've gone through a drawdown, if you're starting to have negative thoughts? Any recommendations?
Yeah, well, the first thing, I would want to know more about the person. Are they trading a system that's proven and has an edge? Have they? So this is where some of the other skills in the book come into play. Have they back tested their system? Do they know their system inside and out? Right. So that testing, I think, is one of the most underrated skills, or one of the skills that people tend not to focus on that much.
Right.
Myself personally, I was reading all these books for ages, and I went through O'Neill and I went through Minervini, and Darwin's like, these guys have things that work. Why do I need to go and do all that work, all that testing? I'll just do what they did. And I learned the hard way that, well, I was actually doing forward testing, because while you could read a book and understand, it's another thing to actually do it. It's almost like reading a book on how to do push-ups, but you get the result when you actually do the push-ups.
Right. Yeah, very good.
So, and that all of the different skills kind of are interconnected in this way, well, with mindset being the thing.
Right. So journaling. Let's talk about journaling.
Okay.
Everyone says it's a good thing to do.
Yes.
Why is it good?
Journaling is good because it allows you to collect the data that will allow you to continuously improve. I see journaling and post-analysis as being very closely related. In the book, I reference it as step 1 and step 2 of continuous improvement. We can't get to the post-analysis without having strong journaling practices, because if we don't have strong journaling practices, what are we going to post-analyze? So,
yeah.
So if we are able to have a good journaling practice, and journaling can mean a few different things to different people. They might see it as writing their thoughts about the market. Some people might be collecting data. At this stage, I'm doing both, and I would actually err on collecting more data than less data when you're first starting out, because you don't really know what is going to be important. So I would err on the side of collecting more than less. But as you're collecting this data, you'll be able to go back and start to see, well, what was I doing well? What led to the positive results? I had a handful of trades that worked and worked very well. What were the common things about these trades that work so well? And you'll be able to find those things very easily if you have a good journaling practice. If you don't, good luck to you. If same thing on the other side, if you want to find out, well, why do I keep on losing money? What's the common factor here? Much easier time to do that if you have a good journaling process that is well organized, clear, and something you could refer back to and go through. Yeah.
So as far as journaling goes, this includes just writing down your trades and so forth, what was behind them, or is it journaling into, this is how I felt, I made some mistakes, I was impulsive?
Got it. I recommend both to the people that I'm coaching. I always recommend doing both. But for anybody that's just starting out, like the first thing to do is to just start. If you could start journaling in a notebook. You could start journaling in a binder. You could start journaling with spreadsheets. Begin tracking your entries, your stops, like all those kind of things, your position sizes. Track thoughts on the day,
Yeah.
what you were thinking, what you were feeling, and why. All those things are important, and you'll be able to come back and look at them and start to analyze, well, why did I make this decision this way? Why did I make that decision that way? As you start to get into some of the other skill sets and you start to develop a system, you'll be able to see if you're on process or off process a lot easier.
Gotcha. Yeah, that makes sense. Yep, it makes sense. So just sit down and start. Doesn't have to be exactly this, doesn't have to be exactly that, but how am I feeling? What did I do today? Did I follow my process? Did I not follow my process? And then some specifics about the trade, the trades.
Right, exactly. And understand too that your journal will evolve with you. My journal continues to evolve to this very day, and that's one of the reasons why I like to keep my journal in a Google sheet. Right.
Okay.
It makes it very easy to share with other people, but it also allows me to, hey, I just learned or found out about a new piece of data that I want to start tracking. Great. I could just insert a column and here it is. And I could start tracking that piece of data. I could run pivot tables on it. And the spreadsheet just makes it very simple to add things and manipulate and run reports on the trades and do that kind of research.
How often do you refer back to past journals?
So I'm doing a post analysis at the end of every month. So like at the end of each month, I'm going back, I'm reviewing all the trades for that month. I'm looking at my average gain, my average loss, my average high watermark, what's my win rate, and a few other things.
Gotcha. Okay, how about number 3, analysis, analyzing trades and markets?
Yes. So whether you are a swing trader, a day trader, whether you're trading stocks or crypto or Forex,
Right.
whether you are Warren Buffett style, right? Like everybody that is participating in markets needs to have a way to analyze the overall environment that they're taking the trades, as well as the trades themselves.
Okay.
And it's between those two, you start to figure out an equation. And the equation is going to be, is this a good environment for my particular style of trading? Yes, it is. Okay, great. Am I finding good trades for this style? Yes, I am. Great. Let me put some trades on. Then you have this third component of your own performance. How am I doing? And then if you start to do well and you're in a good environment, you're finding good trades, and you're performing well, great. Then that's time for you to perhaps start to scale up a little bit, right?
Gotcha.
Things are working in your favor.
Yep.
And the reason why I like this part, Greg, is because sometimes what I found was that I would start to scale up and things would be going great. And then all of a sudden we get a day like today in the market. For those that might be watching it later, it's February 21st, and the market took it on the chin. I was stopped out of a few trades, but we'll get into trade management in a moment. But what it starts to tell me to do is, okay, if the market is still showing that it's a okay environment and the trade setups are kind of so-so, but my performance goes down, then that's something that tells me, okay, this is the weakest link of the chain. I need to start scaling down because my performance is a very important part of the equation.
Sure. Yeah, that's a good point. Very, very nice. Very nice. Speaking of risk and speaking about today, risk, initial capital risk, position sizing, and potential reward. These are a huge thing. These are all huge things in my trading, and I'd like to hear your thoughts on them.
Sure. So risk, the initial capital risk.
Yep.
I learned about initial capital risk from a few different people. I first started to learn about it from O'Neill. Then I started to learn more about it from Van Tharp, and I went through much of his work, Definitive Guide to Position Sizing. Fantastic book, thick book. It's like a textbook. I learned a lot from Mark Minervini about capital risk and position sizing. For sort of, it's related. It's actually a second chapter. I'll leave portfolio heat for the next bit of it, but for the initial capital risk, learning to position size in such a way where we can leverage our size when things are working well, similar to what we had discussed previously, and to start to scale down when things aren't working, but to also make sure that we're risking an amount where we are never risking ruin, where if one trade or a small string of trades could lead us to blow up, and to also be putting on enough size to where we could have a gain and have that gain have an impact. One of the worst things is when a trade goes and is a 10 bagger, but our size was minuscule, and it doesn't really have much of an impact on the bottom line.
Yeah, it's a fine balance, right? You don't want to put yourself at risk. I mean, if you obviously, the calculus of trading is you can have big wins, you can have small wins, you can have break-even trades, you can have small losses. You just need to stay away from those large losses. That's what messes everything up, right? But it's finding that position size that if it goes against you, it doesn't hurt too much, but it's still meaningful if you have a good run and you pay attention to it too. If it's too small, maybe you don't pay attention to it. I think there's something there.
Oh, absolutely.
With my trading, I have a handful of different entry triggers, and what I do a lot of the time is, I kind of give it a scorecard. If it has one trigger, I may take a maximum allowed loss of 0.5% of my account. If it has two, I may go up to 1%. If it has 3 or 4 or 5, I may even get up to 2%. Kind of like in poker, if you have pocket aces, you're going to get more. You're going to bet more than if you have seven deuce. So yes, I mean, when the odds are more in your favor, I like to put on more risk. We've mentioned this before when we interviewed before, but I have an emergency stop. I have an end of day stop. Everything for me is about stops and potential risk to reward too. What are your thoughts on potential risk to reward?
It's a big factor in my trading. It's actually one of the criteria for whether I'm going to take a trade or not. I want each trade to be able to make me at the very least 2-to-1 reward to risk. If I don't have a target that's at least gives me 2-to-1, then I'm not going to be interested in that trade. Yep. Doesn't mean that it's necessarily going to get there, but I want that potential to be there. And that's just the bare minimum. Most of the time I'm trying to get 3, 4, 5 are potential trades. How we manage the trade as it progresses is maybe that's the next topic.
Let's do it. On the trade management. Which is number 5.
Yes. All right.
How do we manage those trades? There's all sorts of different ways to do it.
So the way that I like to start out with thinking about trades, I like to think about them like chess. Okay. So in chess, there's the open game, where you're just starting to develop the positions. Then you have the mid game, where you're kind of making the attack. And then there's the end game, where you're trying to go for checkmate. Right. So in trading, I see it in those 3 ways. But in the open for trading, my number one objective is to get risk off the table as soon as I possibly can. Okay. By following rules, right? Like I'm not just going to start the trade and then stop to break even and stop that would just be silly. Right. So having rules that will get me at my stop to break even as quickly as possible without completely choking off the trade. That's objective number one.
Okay. Any parameters, anything that you do specifically?
Yes, there is. And I'm glad you asked this, because the reason why and how I found these particular rules that I use for myself is because of the journaling that I did, and because of a skill that we'll talk about later on, the post-analysis and the testing, right? So that's how all these skills are kind of fitting all together.
Brings it all back. Yep.
Exactly. So because I had this journaling process, I went back. I did this a couple of years ago at this point, and what I did was I wanted to see if there was a way that I could raise my stop to break even faster.
Okay.
And so I went through all of my trades. Went through it back. I went back through a year's worth of trades until I got to about 100, a little over 100 trades. And I wanted to see what would happen if I raised my stop to these three factors. And each one of these three factors would need to be present to raise the stop.
Okay.
So below the 10-day exponential moving average, below a hold number or a half number, depending on the price of the stock.
Okay.
And below a daily low. I would want it to meet all three of those criteria, and then that's where the stop would be.
Ah, interesting.
So, and how I noticed this was just going through each of my trades for the year, like just one by one, and starting to see like, well, what were some of the common things, like trying to figure out like, what could I do to improve my stop placement as prices starting to come out. So this idea came to me, and so I went, all right, let's test it out on every single trade that I took, because, well, I took these trades, so they must fit all my other criteria. So Let me test it on these. What I found, Greg, was that 95% of the time, it would have been beneficial to exit that way. Only 5% of the time did I get that would have stopped me out, and the trade would have ran without me.
Ah, interesting. It's kind of an aha moment when you journal, you keep track of your trades, you see the data, then you dial in and drill down and go, oh, because being humans, we would probably think 5% of the time it was more like 45% of the time that it went back for us, right?
Exactly. But seeing that, and well, when I saw that, yes, a major aha moment, and then seeing like, well, what would that have done to the results? And I would have gotten anywhere between an additional 20% to 40% return on the year.
Wow.
Mind blowing, right? Just like, holy shit. Sorry for cussing, but yeah, like that blew my mind. So just like, okay, I'm going to go do this. And because I had that level of granularity going through, seeing the results for myself, now I have the belief that this thing works. Would I necessarily have had that level of belief just from reading it from somebody else's book?
No, because you went through all the steps. You went through all the steps. You journaled, you did your back testing, you saw the results, and it just, all of what we've just talked about before, the four spokes of the wheels that we've just gone before, led you to this aha moment, like you said, by being granular, seeing the results. I mean, 20 to 40% difference. I mean, that's really going to emblazon it into your mind to take that stop when it fits that criteria.
Yeah, absolutely. And it's, yeah, well, when you have like just doing that level of granular work really does cement the belief in, and that's one of my personal big takeaways, and one of the things that I'm hoping to convey to people.
Yeah, well, I think this is a really good example of how all, the first four really led you to this very important discovery, just with numbers and data, right?
Yeah, just with numbers, just with data, and something that Uh, I think that it's simple enough that we're all capable of doing it. It's a matter of just doing the actual steps, doing the work, and having guidance too, right? Like having somebody to maybe show you how to journal or like to fit all these pieces together, right? Like there's so much that I've learned about trading through the years, and I've learned different things from different masters, and trying to put it together in a concise way like this, where you kind of see like some of the reasons why to take that extra step to do some of this stuff yourself, get your hands dirty, even though somebody else is the expert, but like you actually going and doing it. I really hope that people take that part away from the book.
Yeah. Trading is a difficult endeavor. And, what I like about your book is it shows how many different aspects of trading. Most people just think it's buy and sell. I mean, it's laughable, right? Because like you said, it's the mindset, it's the entries, it's how to manage the trades, it's, where to go to break even, the journaling, discovering things about yourself. I mean, that's why I like that there's these 8 particular skills that you have to be able to be a profitable trader. I mean, it's just you have to be well rounded. It's just like a professional athlete. I mean, yeah, they go out and play the games, but you don't see them lifting. I mean, in the cold baths and doing meditation and visualization and all the things that they do, watching film, right?
Mm.
So it's kind of similar, watching film of you playing basketball or in a game, or going back and watching your own film by looking at your stats, writing down your emotions. I was off today, I was on today, I didn't follow this. And I just think it's really helpful to go back and be able to look on my screen, to be able to look at these things, both the numbers and the emotions.
Right, and I'm glad that you mentioned emotions there too, because emotions, emotionality, habits, when we're under stress, right? Like it's very easy to talk about this kind of stuff, especially when the market is closed. But when the market is open and the
Lights are blinking.
lights are blinking, it can make it very challenging to take concepts and put them to work. So what are we going to default back to? We're going to fall back on our habits and the work that we've put in, or for, unfortunately, in many cases, the work that we haven't done. So if somebody told me about a rule like this, and I'm going to go and start cutting trades in this way, am I going to have the same level of confidence doing it if I hadn't put in the work? The answer is no. Yeah. Right? Or maybe I do it once, maybe I do it twice, maybe it works out. Then maybe a couple of times it doesn't work out, and I see the stock start running without me, like, oh, there this is. And then you just revert back to the old way.
Habits, everything. I think it takes 28 days to create a habit. And when I have students or people ask me, I'm in a bad shape right here, what do I do? I was like, I always mention this on my podcast, like at the beginning of the month. I'm like, all right, it's a new month. This month, let's be 100% on what we're supposed to do. No impulsive trades. Follow the system, follow your plan, and every day that you can follow it to the T, you've ingrained more of a habit. And after a while, it won't feel like work, it's just a habit. And it's so important to just create good habits, whether it's in sports, whether it's in trading, whether it's in life. But, I do this with myself sometimes. Sometimes, like your example of not taking your stop and really going back and look, I've traded for 28 years. And going back and looking at how I would have done if I would have followed my process to the T, compared to, I decided to, call an audible and kind of on the fly get out of this or something. I mean, I don't know how many years I have to trade. 40 years till I get this down? You know what I mean? I mean, or if ever, but I'm speaking, to other people, but I'm talking about me too. When I get off track, I just say, okay, for the next 30 days, I'm going to follow everything, win, lose, or draw, and I'm going to get myself back into that habit. It's kind of like, before COVID, I used to go to the gym every single day. It was just part of my habit. And then when COVID came and we stopped going to the gym, man, was it hard to get back into it. What was so easy now becomes so hard. And it's the same with trading. Just follow that process to the T, do it for 28 days, and get yourself back into a positive habit.
Yeah, totally agree.
Yeah. Yep. Speaking of account heat, you mentioned earlier, portfolio management.
Yes, portfolio heat. So portfolio heat is a term that I learned from my friend Adam Sarhan. He's
Okay.
the first person that I heard portfolio heat from. And what portfolio heat refers to is the total amount of risk that we're carrying at any one time. So what happens if every single trade that we're carrying goes kaboom?
Yeah.
Right? For some people, that might have been a day like today.
Yes.
So how can we manage that? And what is the how does that play into the whole risk of ruin? Right? So when we start to think about the portfolio management, we want to start to think about how much risk we're carrying for the entire portfolio, that we're not getting too heavy at any one time. So measuring risk, not just on each trade, but for the entire portfolio.
Right.
And also, if we're trading multiple markets, we could start to think about risk in that way as well. Risk across markets, risk across sectors as well. If we're trading stocks, if we're trading multiple different currencies, if we're trading multiple different assets.
Yeah. Yep. That's exactly right. What do you do? How do you calculate if you have two positions that are negatively correlated to each other? Like maybe you're long the VIX and you're short. How do you come to terms with figuring out what my maximum, what's your total account? Do they wash each other?
Well, the way that I calculate my risk is that's where the spreadsheet comes in handy.
Okay.
Because I'll have the spreadsheet open and I'll have my open risk calculated on every single trade. So, I mean, when you could have a hedge where one goes one way, one goes the other way, but that's not, no trade is 100% correlated
Hedged.
where, it's not 100% hedged. So, it really comes down to managing the total risk that's carried.
Mm-hmm. Yeah, that's true. Most people talk about, okay, I'm going to lose 1% is my maximum risk on any one trade, right? That's kind of a rule of thumb people use. But if you have 10 of those, then your maximum risk is 10%, right?
Right.
Yeah, and just kind of a rule of thumb that I use, I don't like to put any more than 3% total heat risk on my account. And usually maximum I'll have about 6 positions. Each position's maximum risk is about 0.5%. So that gives me my 3%. And then of course, if I scale out or take profits or something, it adjusts that. But I've noticed a lot of people say, oh, well, I have a 1% risk, that's it. But they have 10 positions. Like, that's 10% risk.
Right.
Yeah. So total account heat is very important. I don't think people talk about it enough. They talk about the risk on just one particular position, but of course, you have to factor in everything, even if they are negatively correlated, because you never know, right? You never know if something that's supposed to go up and the other one's supposed to go down, they do the opposite.
Right, exactly. That can happen in your portfolio. And something else that I like to track is the trade ideas. So every day I'll screen for stocks that I come up with my lists, and I come up with the stocks that are setting up. Whether they're a good setup or a bad setup, high quality, low quality, I'll keep them all on a list. And each day I'll track how that list is performing for the week. So are the majority of them up on the week, or the majority of them down on the week? And that'll give me a great tell on market conditions as well. So on a day like today, 96% of the list was negative.
Yeah.
Right. So that's also telling me that most stocks are getting hit. And if I'm carrying, or even if I wasn't carrying these stocks, the portfolio heat on all of them would just be like getting smashed.
Yeah.
So when we take into account portfolio heat, it helps us to turn the dial on the stove down a little bit. And it's a good reminder to don't overcook our trades.
Yeah, because I mean, at the end of the day, as traders, we really our main focus should be risk management, right? I mean, that's really what we are. We're risk managers. We're looking for our setups. We're looking for our entries, good risk reward ratio, position size correctly. But when those stops hit, when your end of day stops hit, or whatever kind of stops you're using, boy, you've got to get out, because that first loss is the easiest loss. It may sting for a minute, but you'll forget about it by the next day. But you'll sure remember the ones that you've held on to and held on to and held on to. Because, I always tell my students and listeners that you need to be very, very impatient with your losses, and you need to be very, very patient with your winners. But human nature, as it is, we're kind of wired the opposite way. We're always hopeful and oh, it will come back and da 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 da. But the winners, want to take that real quick because it feels good, and that's why so many people lose money trading, because we need to do the opposite. We need to be very patient with our winners, and we need to be very impatient with our losers.
Yeah, well, so I started to think about something that's very similar to that, and when I used to think of myself as being in the driver's seat of trading.
Okay.
Like I'm the person that's sitting here, I'm the one pressing the button. So therefore I'm the player.
Okay.
When eventually I changed that mindset to thinking that no, I'm not the player, I'm the referee. And the stock is the player.
Oh, interesting.
So I'm the referee, or I'm the game master, and I come up with the rules. So this stock comes in to play my game. It has to play by my rules.
Gotcha.
Now, I'm going to allow the stock to be in the game, be in the arena, so long as it plays by the rules. The moment that it stops following the rules, kick it to the curb.
Yeah, you're just the ref. You're out.
Yeah,
I like that.
Yeah, that was a major mindset shift. Like it's a subtlety, but like it had major implications.
Oh, very good. Yes, very good. Number 8, testing, factor modeling. What's factor modeling?
So factor modeling would be looking at what works and trying to figure out why.
Looking at what works and trying to figure out why. Okay.
Yeah, basically what O'Neill did with Can Slim.
Okay.
He saw what Fidelity was doing at the time, and tried to say, well, why are they buying stocks at 52-week highs, and then going through those trades and saying that, oh, well, they had earnings, they had sales, and
a new product.
Yep. So that's factor modeling.
Interesting. Backtesting. We know what backtesting is. Contrast backtesting with forward testing.
Sure. So backtesting is testing the easy way, and forward testing is testing the hard way. So backtesting is you get data and you see how these trades would have worked given whatever rules you're going to set up. with forward testing, you would be taking your set of rules and testing it on trades that are happening right now and going tick by tick, day by day, whatever your time frame is.
Very good.
So it's a lot slower.
How did you come up with the idea of this book? How did you come up with the Trading Mind Wheel? Like, was it just over the years? There was this one and there's that one, and you just finally had the last one that filled in the spokes or filled in the wheel?
So the way that I came up with the idea for the book, it's really was trying to figure out, well, why is this game so damn hard? and as I started to go on a spiritual journey into it, like to try to find out a lot about myself and a lot about my past.
Okay.
And this, excuse me, this part of the journey started maybe about, I'd say 6, maybe 7 years ago.
Okay.
Started to look into things like meditation. Started to look into things like I was already studying psychology. I started to go to different events. People like Tony Robbins.
Yeah.
And I started to dig into some of the things that at the time back then were holding me back.
Okay.
That I thought were holding me back, like mental blocks.
Okay.
And in doing that, I started to dig into much of my past. A lot of it is covered in the book.
Yep.
And what I started to realize is it kind of came back to what Van Tharp had mentioned when he was talking about we're not just trading, we're trading our beliefs about the market, not the market.
Right.
So
can you give me an example of that, of trading your belief and not the market? Can you kind of give me a real world example of that?
Sure. So let's say you have your system.
Yep.
We're only able to act based on our beliefs, based
Okay.
on beliefs that we have. So your typical 3-year-old child will have no problem just running right across the street.
Yeah.
Right? And why is that? They don't have the belief that getting hit by a car might not be a good thing.
Yeah, good example.
So an adult has that belief. So they're not going to run across the street.
Mm-hmm.
So if we have certain beliefs about trading, certain beliefs about money, or certain beliefs about ourselves, we'll either be able to act well or not act well. Act in a way that's going to get us to the result that we're after or not. The problem with beliefs is that many of them are habit. Many of them are running in the background. Many of them are in our subconscious and running on autopilot. So we might have beliefs from years and years and years ago that are causing us to take or not take certain actions. And when we are under stress, we'll defer to those older patterns.
Childhood traumas, things like this?
Yes, absolutely. So one of the things that I speak about in the book was childhood homelessness. Well, when I was a kid, I was homeless for a period. Went to go live with my dad. Afterwards, my parents were divorced. I was living with my dad and with my stepdad and my mom. He came home one day and told us that he had lost his job, and the bills started to pile up, and soon we were evicted, and for a couple of months we were homeless. My mom eventually decided, you know what, Michael, you don't need to live like this. I'm going to go send you to live with your dad. And so I went off to live with my dad. Very quickly, I learned the importance of money. Right? At that young age, or at least having enough money to keep the lights on and food on the table. I went to go live with my dad, and he was a very hard worker. He worked in a grocery store, managing a grocery store, and he would work a lot of overtime. And he would come home. I wouldn't see him that much because of so many hours he was putting in, but we always had food on the table, the roof over our head, but I could tell how much he hated his job. He would often complain about it. And that taught me another lesson, and the lesson that it taught me is the value of time, and particularly time with family, because I had food on the table and a roof over my head, but I didn't have much time with him. And that, given the leaving my mom and stepdad and going off to live with him, and then living with him but not living with him, in a way, was something very painful and something that I was processing, but not processing, just something that kind of became my reality at that time. So I started to place values, and as a child, that my values and beliefs are developing, and I started to have certain beliefs about myself and certain beliefs about money. And as I grew older, those beliefs are still there, but they're operating in the background. So I learned about trading and the stock market, and it seems like this great thing where you can take a little bit of money and grow it into a lot of money over time with the magic of compounding.
Yep.
And then, it just seemed like this great thing, but why then when I place a trade and it starts to go in my favor, I want to take that money fast? And why do I keep on self-sabotaging? Well, why does this keep on happening? I'm studying for a decade, and it took me a decade to finally start to turn the corner. Right? Like I had massive trust issues with any kind of authority figures. And yeah, thinking back on it now, at least part of it goes back to some of the childhood stuff.
Sure. Yeah, absolutely. I was raised very poor as well, and always very anxious about money. And as life went on, things got better that way. But it's still there. I can still feel it. It's when my equity curve gets up to a certain point and never can't quite get over it, and it goes down and gets right back up and goes down. I'm like, why can't I get over that amount? Do I feel like I'm not worth it to get over that amount? Do you have thoughts on that? Because I have heard this from many traders.
Okay, so the first thing that I would be curious about is your the system, and is it so you have if we didn't know each other, I would start asking you about your system, and following that and the beliefs about the system, and I would also be curious about beliefs about yourself, beliefs about trading, beliefs about money. Start to see if there's anything that's disconnecting you between your goal and where you're at, right? And how can we make the map to get you from where you are to your end goal?
Yeah, I saw in the book when I was reading the book that there are some questions that you can answer that you formatted in there, that you'll ask a question, how do you feel about yourself? And you write some things down, and you have other questions, you write some things down. That seems really helpful.
Mm-hmm.
And that's in the book, right?
Yeah, so all that part is in the book, yeah.
Yeah. Yeah.
So as far as your equity curve and hitting a ceiling on that equity curve, yeah, that's interesting. I you know what? I would kind of be curious to hear about, well, first off, why do you think that is?
Well, like I said, I've had many people tell me the same thing.
Okay.
They look at their equity curve and it just gets like up into resistance. And I don't know, some of it, of course, is market related, obviously. But I don't know. I
Well,
wonder if it's, for people, if it's a self-worth issue when it
well,
gets
when
up
are you
to that
looking at the
level.
equity curve?
Excuse me?
When are you looking at the equity curve? At what point? Like, are you seeing it get to that level and just like, wow, like this is the highest that it's ever been? Oh, damn it! Is
Well,
it like that?
I look at it every day.
Mm.
I look at it. I look at it every day, and so yeah,
Why
I
do
don't
you look
know.
at it every day?
Habit.
Is that habit serving you, or some part of your trading? Like maybe it is. I don't know. But like these questions aren't meant to be charged.
Sure, sure. Um, well, I just tend to look at it every day, just because it's what I do. But I honestly, I don't think that I am trading any differently around it. And sometimes, yeah, of course, I break through that, and I'm like, oh, and it's just kind of a personal victory for me. Oh, I finally got above that thing, because I think it just starts getting in your head a little bit. And if it gets there and it goes back down and you're trading correctly, there's really nothing you can do. But I guess if you get to a certain level and you start changing your process, or you start self sabotaging, that could be a reason. I mean, for me, I trade pretty well and I really
Mm-hmm.
don't self sabotage, but a lot of my students and other people, I have heard this, so there's got to be something to it, because I've heard it from so many different people.
Hmm. All right. So if you're getting to a certain equity curve, right? So like are you measuring in dollars? So like my account's up to $1 million, it's up to 2 million, it's up to is it like that?
Yeah.
Okay. So what if you, as you're getting closer to that level, you take X amount out and it's kind of resets the amount, and so it
Oh,
allows you to climb back.
yeah, I like it. It's a little bit of a loophole there, isn't it?
Yeah.
Yeah, I think that's a great idea, Mike. I really do. I think that's wonderful. Yeah. Sometimes it's just a little hack here or there, right? Just to calibrate us back in.
Yeah, it could be.
How is your trading going this year?
Yeah, so far this year I am negative on the year. I am down about after today. I'm down about 2%.
You can come back from that,
Yeah,
right? You can definitely come back from that. Yeah, it's been interesting. I don't uh, all the times that we've spoke before and interviewed and so forth. Um, Big picture, what is your trading approach? Is it breakouts? Is it dip buying? Maybe you could share that with us.
sure. So I like to buy breakouts.
Okay.
I like to buy a handful of setups. Like I prefer to trade generally the same 4 to 5 setups uh, routinely, and to not deviate too much from that. I feel like the fewer setups we have, the more we're able to master those setups. It's almost like the that famous Bruce Lee quote, right? Like fearing the man that's practiced one kick 1,000 times versus the person that's
Yeah,
practiced 1,000 kicks one time.
exactly. I love that one too.
Yeah. So um, breakouts from flat bases, breakouts from VCPs, um, cup with handles, pullback buys, and the occasional high type flag when it presents itself.
Gotcha. Gotcha. So the book right now is in pre-order mode. Is that correct?
Yes, it's available for pre-ordering on Amazon, Barnes and Noble, uh,
BAM,
Walmart. Yeah, like BAM, all these places.
Walmart. And so in the description, I will put a link, tradingmindwheel.com. So the viewers, if you'd like, you can go down there, take a look at the book and see where you want to order it from. I really suggest, we've covered these 8, but I mean, it's what, a 300-page book, I believe, right?
Yeah, just about.
Yeah, 304, and I think it would be worth anyone's time and effort and money to read this book, internalize this book, because I really respect you as a trader. I really do. I mean, of course, I follow
Thank you.
I follow you on Twitter, and we've had interviews before, but I really do, and I wouldn't do this interview unless it was something that I really believed in. And yeah, I hope people will go out and get the book, and I will post it all in the description here. And also for Mike on Twitter, he can follow him at Michael G. Lamothe on Twitter as well, and I'll post that as well.
Oh, fantastic. Oh, and one more thing too. If you do, for anybody that orders the book, make sure that you go back to tradingmindwheel.com and submit your receipt, because there's bonuses that come with the book. The first bonus, the biggest one, if you just buy the one copy of the book, you'll get access to admittance to a virtual conference that we're going to hold that day. A full day virtual conference.
Oh, nice.
Yeah. We've got Jim Ropel's going to be a panelist. Adam Sarhan's on there. Jason Greystone is emceeing. Austin Summer, we've got a lot of people that are going to be a part of this thing. It's really, really cool.
So when they buy the book, take a snapshot of the receipt, go back to tradingmindwheel.com and upload it, and then they'll have access to that. Is that correct?
Yes, exactly.
Okay, great. Anything else we want to cover that we haven't covered?
No, I think that's about it. I hope that this was valuable to the listeners. And if they have any questions, yeah, you gave my social media handles, and Michael G. Lamothe at on Twitter and Instagram, all over the place, and tradingmindwheel.com. Yeah, I think that covers it.
Well, thanks for spending the time, put this together. I'm proud of you. It's a big endeavor to write a book. I'm sure it took a lot of effort and a lot of time, and we're going to be the beneficiaries of this by reading the book.
I really appreciate it. Thank you so much, Gregg. Always
You're
a pleasure
welcome.
talking with you.
You're welcome, bud. Okay.
U.S. government required disclaimer. Stock, options, futures, and Forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.